So here it is. What is the Smith Maneuver? So the Smith Maneuver is a long-term financial strategy that allows you to convert your mortgage debt to a 100% tax-deductible investment. So you will be able to reduce your tax bill, you're going to get rid of your mortgage in record time, and you're going to build your own free and clear, non-regulated investment portfolio. So each month, you're able to invest money you wouldn't have otherwise had. You're going to generate tax deductions, and these are going to grow over time. And again, that mortgage is going to be gone very quickly because you're able to prepay it where otherwise you wouldn't have been able to. So these benefits start now and they happen simultaneously. The best part is that this requires no new cash from you. It's a simple financial restructuring that allows this to operate. So how does this work exactly? So each month, you're going to make the regular monthly mortgage payment as usual, whether you're doing the Smith Maneuver or not. This is going to reduce the mortgage balance owing each month. So the mortgage that is required for the Smith Maneuver is called a readvanceable mortgage. This means alongside your amortizing mortgage, you will have an attached secured line of credit. So every time you make a mortgage payment, the secured line of credit will increase dollar for dollar at the principal amount. So you're allowed to reborrow whatever equity you created by making the mortgage payment. Now, you take this newly created available equity and you use it to invest. So by investing the equity, it triggers a tax deduction. So there's a tax relief from the borrowing to invest because we are borrowing with the expectation of generating income. So you're now building up your investment portfolio. We do this each and every month. You pay down the non-deductible mortgage debt, reborrow to invest. This is going to create a tax refund. So when you receive that refund, you now apply this as a prepayment against your mortgage. Prepaying the mortgage is ideal because when you prepay any funds above and beyond your regular mortgage payment, it goes directly to principal, which means you're paying the mortgage out faster. Now, this amount that you're prepaying, you can reborrow, get it invested as well, and the cycle continues. So here is your typical mortgage. This is what most Canadians have. Let's say I scrape together a down payment and go to the bank. I borrow $400K and I promise to pay that off over the course of 25 or 30 years. It's 100% non-tax deductible. It's non-tax deductible and crazy expensive. What you need is a readvanceable mortgage. It has the same amortizing loan as we see here, but it also has that line of credit attached to it. So the nature of this means that as soon as I pay any of the principal down on this one side of $400K, I'm able to borrow that amount and get it invested. So let's look at this. I have a $2,100 mortgage payment. Most of it is going to interest, but $770 reduces the principal. So that $400K goes down to $399, $230. That's down by $770. Now the line of credit increases dollar for dollar. So now it opens up by $770. I pull this out and do whatever I want with it, right? No, if I borrow to consume, so if I buy a car or make car payments or go on vacation, there's no tax deductibility. But if I borrow with a reasonable expectation of generating income, I can deduct that interest. So here again, $770 reduces the principal. I borrow that back to invest, and I repeat this on a monthly basis. Pay down, reborrow to invest. And here is what that looks like. So what I end up with is a $400K investment loan that's a 100% tax deductible, which means I am receiving very large tax refunds on an annual basis. It's free money from the government, money that I otherwise would not have received. So with these refunds, I'm able to prepay the mortgage throughout the course of this conversion process, which means I'm getting rid of that mortgage faster. I'm paying less in non-deductible interest, and less is always better. In this monthly investment I've accomplished, plus these annual tax refunds, which get invested as well, means I'm taking advantage of compound growth now rather than later. So what's it worth? For the typical Canadian homeowner, using the info we saw today, the plain Jane Smith Maneuver with no bells and whistles is worth around $400K improvement in net worth over the course of the amortization of a mortgage. But there are accelerators which speed things up quickly. So we have the debt swap, cash flow diversion, the DRIP or Dividend Reinvestment Program. We have Prime the Pump and the Cash Flow Dam Accelerator. And let's look at the debt swap. So let's say I have $10,000 built up in a non-registered investment. I had this investment for a while. What I choose to do is redeem this investment, whatever they are, stocks, bonds, mutual funds. I want to look at taxation, but I can redeem these investments for $10,000 in cash. And I take that cash and I make a prepayment against my mortgage. This is above and beyond my regular mortgage payment, so it goes to principal. This is the debt swap. So now that 400K goes down to 390 of non-deductible debt in a single day. And again, because this goes down, I can reborrow that 10,000 from the secured line of credit and turn around and buy the exact same investments if I want, or different investments. But before swapping, you're going to want to consult with your Smith Manoeuvre certified investment advisor about the superficial tax loss rules, of course. However, theoretically, I have an investment on Monday. I redeem it on Wednesday or Thursday. Thursday, I get the cash, make the prepayment. A few days later, I reborrow and buy new investments. So I'm still invested in at 10,000, but I've just converted 10,000 of non-deductible debt to deductible debt. So it's a simple restructuring that requires no new money. It's a very powerful move. Okay, so let's talk about the cash flow diversion accelerator. So a lot of times what happens is when people receive their salary or their paycheck into their personal checking account, they think they're doing wonderful things by investing some of that. So $400 each and every month gets pulled from their checking account directly into their investment. So here's what they could be doing instead. So you should take that $400 that was going to get directly invested, and first make a prepayment against your mortgage. So the mortgage balance decreases and you're able to reborrow that same $400 and then get invested the same way you were prior. So if you are prepaying on a monthly basis by $400, the mortgage will be gone in no time. So you have the DRIP accelerator or dividend reinvestment plan. So I've got an investment portfolio, probably stocks or ETFs that send out dividends. So it could be a monthly, quarterly, or annual basis, whatever it is. So many times people will say they don't want the dividend in cash, or will set their portfolio to automatically purchase more shares of a company. So instead of the cash coming in, the slated dividend will just buy more units or shares of that investment. So here's what you could be doing. So instead, you request that the dividends come to you in cash. You see where I'm going with this, right? So you're going to prepay that mortgage, reborrow that same amount of $300, and then you buy the exact same stock or ETF that you would have if you were automatically buying those units through the DRIP program. So again, another $300 or so a month prepaid against the mortgage. The mortgage is going to be paid off very quickly. Okay, so we're going to talk about the Prime the Pump Accelerator. So if I have the wrong type of mortgage and I want to do the Smith Maneuver, I have to refinance into the appropriate readvanceable mortgage. So let's say my house appraised at 500K. Well, the maximum LTV or loan to value that a lender is willing to give is 80%. So that means they're willing to lend 400K. So I need at least 100,000 of equity in the house. So they lend 400,000, and every penny of that is required to pay out the mortgage that I already have. So this wouldn't necessarily work for this accelerator. So that means the limit on the line of credit will be $0. So they loaned me the total amount that they're willing to, and that's on the non-deductible side. So I can only access this equity when I make the first payment against the mortgage. So whenever that goes down, I can reborrow that to invest. And that's just essentially the plain Jane Smith maneuver. Now, what happens if I had a 600K appraisal of the house? Well, 80% LTV or loan to value of that is 480,000. So they're willing to lend me 480, but I only need 400 of that to pay out the current mortgage. But since they're willing to lend me 480, so what they'll say is on the line of credit portion, we'll give you 80,000 of available credit on day one. So I can do whatever I want with this, but what we do with this is very important. So I'm going to pull this 80,000 and invest in securities, in a new business, invest in real estate. So any number of options that still maintain deductibility of that borrowing plus improve my net worth. So this is going to generate significant tax deductions immediately, and it's going to see you take advantage of compound growth right away. So just to be clear, the prime to pump amount would be invested directly, not used to prepay the non-deductible mortgage loan. That's very important. Also, this is considered additional leverage and should be carefully considered in conjunction with me, your Smith Manoeuvre certified mortgage professional, a certified investment advisor, and accountant. So the cash flow dam accelerator. This is for people who have a proprietorship. So this is not a corporation. Corporations are taxed and considered separate from you. So it has to be a proprietorship. So it is a proprietorship that could be a home-based business or someone with a rental property even. So what you may think is the correct thing to do is to take the tenant's $2,000 into your bank account. You're going to use those funds to make the mortgage payment on that rental property. But you're missing out on a very valuable opportunity here. So if you employ the cash flow dam, you will receive that $2,000 from the tenant, but you should make a prepayment against your own mortgage or your principal residence with the $2,000. Now you reborrow that $2,000 back into your business account, and then you service the expenses on the rental property or business expenses. So if you're prepaying the mortgage by $2,000 every single month, you can see a 25-year amortizing mortgage be obliterated in 10 years or less. So it's extremely, extremely powerful. Many people will say, if I've still got the same mortgage payment, whether I'm doing the Smith Manoeuvre or not, but if I am doing the Smith Manoeuvre now, I have that increase in balance on the line of credit. And if it's not coming out of my pocket, where is it coming from? All right. Well, if I have a regular mortgage payment of $2,214 every single month, the very first month that I make this mortgage payment, a huge amount goes to interest. That's $1,486. It's non-deductible interest. This is why mortgages are so expensive. But some of it goes to reduce the principal. And in this case, $728 for the first month. So I reborrow that $728, I get it invested. So the next month, same mortgage payment, but the rate is being calculated on a lower balance. So less goes to interest and more goes to principal. So I reborrow the full $730. It turns out that $2 is required to service the previous month borrowing, leaving $728 to invest, just like I did in month one. So the third month, same thing. Even more goes to reduce that principal. I reborrow the full $733. $5 is needed to service the interest on the first 2 months borrowing. So again, have $728 to consistently invest. This is why I'm able to keep the monthly amount constant, and the increasing efficiency of that regular mortgage payment takes care of the interest expense that is accumulating on that line of credit. So no new cash is required to implement the Smith Manoeuvre. Now, I like to say there is a calculator for everything, especially in the mortgage business. So I'm actually going to walk you through an extensive demonstration of the Smith Maneuver using our calculator and an example case. But for legal purposes, of course, a disclaimer is required. So this calculator is for illustrative purposes only and should not be relied upon as an accurate indication of your financial retirement needs. As each individual situation is different and changes over time, the results are limited by the accuracy of the assumptions used in the calculation. I or we do not guarantee this calculator is reliable, accurate, or complete, or that it will be compatible with your personal situation long term. Please consult your financial advisor and accountant for best results. Okay, so here are the assumptions for this scenario. So for income, let's say we have $150,000 annual income. We have a rental property which generates $36,000 a year with rental expenses of $34,000. So on the asset side, there's $30,000 of paid up non-registered investments. There's a $350,000 investment property, and we have $10,000 of emergency funds in cash. So for liabilities, we have $10,000 non-deductible consumer debt, $5,000 of deductible investment debt, and a mortgage on our investment property at $200,000. So we're at the 43.41% marginal tax rate, and our principal residence was appraised at $750K. So the current mortgage balance is $450. The rate on that mortgage is 8%. I put it a little bit higher because that's where we're at in the market right now. but the amortization is 25 years. And on the borrowing side, on the readvanceable mortgage, the line of credit rate is 6.95%. Okay, so using our example case assumptions, we're going to start at the top here. Our annual employment income is around 150,000. Our annual rental income, I've got a rental property. I receive around 36,000 in annual rental income. I don't use any of the rental income for living expenses, but my rental expenses are around 34,000 annually, right? So what this is saying here, based on my inputs, this is telling me that my gross annual income is around 186, my expenses are 34,000, and my overall net income is 152. So let's go to assets here. So let's say I have stocks in a non-registered investment account that amounts to around 30,000. The investment property is, as we said, around 350,000, and I have 10,000 in emergency funds. Okay. So for my liabilities, on the non-deductible side, I have 10,000 in credit card debt. That's cost me around $300 per month. So this is debt that I'm not able to pay out at the end of each month. This is being rolled over month after month, and I can't seem to pay it down, right? So for deductible investment loans, I have a personal line of credit, which I use to invest. I pay $200 a month and is around $5,000 balance on that. So my mortgage balance on my investment property is around $200,000. For this calculator, it automatically calculates BC, but since we are in Ontario, let's say we know our marginal tax rate is around 43.41%. We said my home market or appraised value is around 750,000. My current mortgage balance is around 450,000. The rate or the interest rate is at 8%. Amortization is 25. I'm paying monthly like most people. Now on the readvanceable line of credit side, the current prime rate is around 6.45%. I'm going to have a premium on that line of credit of about 0.5%. So prime plus half. So the borrowing rate on that line of credit is 6.95%. So the investment portfolio growth rate is what I estimate my investments will grow at over time. So let's use 8%. What this is telling me is that I have $362 to invest in the first month. So in the first month, we make the first regular mortgage payment. Month 362, this is going to be reduced on that mortgage loan to go to principal. So I'm able to reborrow 362 to get it invested, and I can invest some of it, or in this case, I'm going to go ahead and say I'm going to invest all of it every single month, and we're going to be able to see some of that data. So taxation improvement. So over the course of the 25-year amortization period, I'm going to have 202,000 of tax deductions. So tax deductions with my current mortgage, we know is going to be $0, but based on the 202 and deductions in my marginal tax rate, I'm going to get over $87,699 in tax refunds from the government over the years, which is just very nice. So let's look at net worth. I'm going to have at the end of the amortization that I inputted into this calculator an investment portfolio of $395,624. So I'm going to have a converted mortgage, a 100% tax deductible debt balance of $337,500, which means my net worth improvement is around $58,124. And that's just borrowing to invest on a monthly basis. Now, this section here, the mortgage component breakdown, you'll notice we have an opportunity to reduce that amount of borrowing we accept from the lender. It's a little bit complex, but the less we accept from the lender, the more our results are actually going to improve. And the reason is taking into consideration the 65% HELOC rule. So based on the numbers I inputted, I can only borrow on the line of credit side 65% of the total value of my house. So if I accept the full $600,000 that they're willing to lend me based on the value of my house, these are the numbers that I have to work with. So I have 112.5 that's not going to readvance. I have 337.5 that will readvance, and I have immediately available credit of 150,000. So if I reduce the total loan I accept from the lender from 600 to, let's say, 550, we'll see net worth improvement increase a little bit, but that's because the bigger proportion of my non-deductible mortgage is able to readvance right away. So, a smaller portion does not. So I get better results. But the lower I make this accepted borrowing from the lender, the less immediately available credit I have. So if I go down to, let's say, 500, we'll see our immediately available credit drop. So our results improve, but we have less to borrow on day one. Okay. Okay. So do you wish to apply your estimated tax refunds to Smith Manoeuvre? We're going all in. So we're going to say yes. We're going to apply these tax refunds, and we'll see an improvement in amortization and net worth. So 25-year amortization of that non-deductible debt reduces to 21.58, and I've got a net worth improvement of 260,241. So a 658,902 portfolio offset by my deductible investment loan leaves a net worth improvement of 260 with just the standard Smith Maneuver. So there's no new cash required. So we're going to check out some of these accelerators. Now, for debt consolidation, I immediately have 100,000 of borrowing power when I refinance my house based on the house value. So with that 100,000, I can consolidate non-deductible debt. And I've already indicated on the first sheet that I've got 10,000 in credit card debt that I can't seem to get rid of. So when I hit this, this is going to consolidate it on this 10,000 on the non-deductible side of the mortgage. We're going to see these numbers improve in tax and net worth. So when I consolidate it to the mortgage, I start to convert that 10,000 of consumer debt into investments. So now that 10,000 a month, when it was my credit card, was costing me $300 per month. So that's the minimum payment that I was required to pay every single month. So another option is to still come out of pocket with 300, but instead of going to the credit card company, it's now going to go as a prepayment against my own mortgage. So then I'm going to reborrow it, get it invested. And when I do that, we're going to see huge improvements here. So the amortization now, 3.42, net worth, 266, 7.50, 647. So this is just consolidating the debt I already had and using the same funds I was already using. So right now I have at the end of 25 years an investment portfolio of over $1 million offset by my 100% tax deductible investment loan means I have a net worth of 647,242. Now, after I consolidate this 10,000, it's going to change my monthly payment a little bit, but it will be nowhere near the $300 that I was paying before. So I originally had 100,000 of immediately available credit. So then I consolidated 10,000 of that. So now I'm down to 90,000. So this means that the line of credit portion of the readvanceable mortgage would be paying this out. So yeah, it's still deductible. I want to maintain that debt, but I want to pay a lower rate of interest than what's sitting on my personal line of credit. So I go and I say, I want to preserve the 5,000 on my line of credit the day that I refinance. I was paying $200 per month to service that deductible debt when it was on my personal line of credit. So now I'm instead going to prepay by mortgage by that $200. So it's going to be able to service that $5,000 on that line of credit that I preserved. And let's look at the data here. So 7.5, 619, 9.33, 862. So the value of the investment portfolio is now 1.28 and net worth improvement is 862 with almost 10 years shaved off of the amortization. Now, let's look at the debt swap accelerator. So I said I have 30,000 in stock. So if you remember, the debt swap says to redeem your investments for cash to prepay your mortgage, reborrow, and get back invested. "25 years has gone down to 13.5, and I have over 1 million in net worth improvement. So this is a game changer if you're paying attention here. So now I also indicated that I have 10,000 in cash, or near cash as an emergency fund. So if I go out and I get a personal line of credit, if I don't already have one and I promise myself not to use this personal line for anything but an emergency, then I have access to emergency funds, right? I don't pay anything for it if I don't use it. But that means I can now take this 10,000 in cash, which has been sitting in an account somewhere, earning me close to 0%. And I can apply it as a prepayment against my mortgage, reborrow, and get it invested. 1.7 investment portfolio, 1.2 in net worth improvement. Cash flow diversion. So let's say each month I was contributing $200 to my investment portfolio directly from my bank account. What we want to do is divert those funds prior to getting invested. So we're going to prepay the mortgage and reborrow. So it's 13 years off the mortgage. That's 1.5 in net worth improvement. So for those of you who have rental properties or home-based business that are proprietorships, you can use this to your great advantage here with the cash flow dam. So as I indicated on a previous sheet, that 36,000 of annual rental income translates to 3,000 a month. But the expense translates to 2,833 a month, which means when I get that 3,000 from my renters, I'm going to first prepay my mortgage of my primary residence and then reborrow the full 3,000, but only 2,833 needs to go to service that rental expenses, which means the difference can get invested for growth over time. So we're also prepaying by 3,000 a month. So that's going to do wonders for our amortization here, which is currently at 11.83 years, down from 25. 19.25 years saved, 1.8 in net worth improvement. So as we stated with the dividend reinvestment plan, instead of automatically reinvesting to buy more shares of a stock of units of a fund, I'm going to request that these dividends come to me in cash. So then I'm going to reborrow, buy the stock or the mutual fund. So there's not a lot of improvement here because remember, these dividends were going to get reinvested anyway. So this is just a way to make my money work harder for me. And we're going to assume a 8% yield here. So we're going down to 19.75 years saved and 1.8 million investment portfolio. Now, initially, I had $100,000 of immediately available credit when I refinanced into my readvanceable mortgage. So I consolidated 10,000 of non-deductible debt, which then brought that down to 90,000. So I consolidated another 5,000 of that deductible debt, which then brought it down to 85,000. So now, after I refinance into my readvanceable mortgage, consolidate and preserve existing debt, we've got 85,000. So that I can invest. I can invest in securities, or I can invest in a rental property, a new business if I want. I'm going to go ahead and say, I'm not going to pull all of this out. I'm just going to pull 50,000. Okay. I'm just going to use that. Let's say if I wanted to buy a rental property or something. So that's 20.17 and 2.61. Yeah, 2.76 investment portfolio. So all accelerators accounted for, my 25-year non-deductible mortgage is converted into a deductible investment loan in about 5 years. And at the end of the 25 years, I have an investment portfolio of 2.7. Minus the investment loan, I've got a net worth of 2.2. So just to be clear here, with the prime to pump, this 50,000 or 85,000, if I pulled it all out, this is new borrowing. So this is borrowing that I didn't already have. So based on the values that I've inputted here, the rate on the secured line of credit, 6.95%. If I pull that 50,000 out right away to invest, it's going to cost me $290 a month in interest. So the calculator takes this into account and says, if you prime the pump of 50,000, that's going to be an extra $290 in interest expense. So the calculator is applying that 290 automatically as a prepayment against the mortgage. So when that line of credit increases its limit, that 290 is available to service the additional borrowing. So essentially what this says is, since this is new borrowing, we're going to assume that you're going to come out of pocket by the incremental interest expense to use as a prepayment against the mortgage. In order to pay back the 450,000 mortgage without the Smith maneuver, you're also going to have to pay over 603K in interest. But you have to make these payments with after-tax dollars. So you have to earn $1.8 million to pay off $450,000 mortgage. That's why mortgages are so expensive. So the net value of the Smith maneuver here, this is explaining the net value of implementing the Smith maneuver versus continuing the course with your existing investment plan. And you'll recall that 30,000 that we debt swap, that monthly cash flow diversion. If I just continue doing that without the Smith maneuver, the future value of the current plan that I have of investing would be worth around $410,411. So the future value of the Smith maneuver is 2.2 million, which is this number here. We're going to subtract the net value of implementing the Smith maneuver with these accelerators versus not doing the Smith maneuver, but continuing on your own investment plan. I get a net value of 1.85 million. So deciding to do the Smith maneuver with these accelerators is better off compared to your existing plan, in this case by over 1.4 million. So that's the power of the Smith maneuver by the numbers. Okay, so as previously mentioned, here are those benefits again. So each month, you'll be able to invest money you otherwise wouldn't have available to take advantage of compound growth. You're generating valuable and increasing tax deductions. Your tax deductions and refunds increase year after year. This enables you to eliminate your mortgage in record time. So again, the Smith maneuver is a disciplined financial restructuring debt conversion strategy that will have immediate and long-lasting benefits for your overall net worth. It works in every market condition, no matter what the interest rates are doing. The wealthy have been doing this for years. Don't just sit on the sidelines with this information. This is your chance to take advantage of this powerful wealth strategy right away.